to the Inspire Wealth podcast with Prof M, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Prof M, aka Mallory Meehan, and today I am joined by Arn. Arn, how are you doing today?
Great, Mallory. Thanks for inviting me on your show, and look forward to having a nice chat and hopefully educating people a little bit more about real estate investing.
Love that. Love that. Okay, so Arn, the first thing I usually ask my guests are, tell me a little bit about yourself, tell me how you got into real estate, and then we'll kind of dive into, the nitty gritty.
Okay, sounds good. Yeah, so pretty typical American kid. Parents said, go to school, work hard at school, do well, get a degree. So I kind of did all that, ended up with a master's degree of chemistry from the University of Michigan, go blue, and never did anything with it. So I grew up in the San Francisco Bay Area, and my father had started a residential brokerage business in Menlo Park in Palo Alto, California. When I came to the conclusion academia wasn't quite for me, he said, come on out, get your license, and I'll put you to work. So I started as a residential broker in March 1978, and did that for 35 years and watched the San Francisco Peninsula transform from primarily an agricultural community county into Silicon Valley. And the other aspect of it, my father, in addition to being a broker, was an investor. And so he kind of taught me the investing business. He did single family homes. And at that time in the Bay Area, you could actually buy single family homes that made sense as rentals. Not so much the case anymore. And so I kind of followed in his footsteps, built a brokerage business, started buying single family homes as rentals. At one point, started investing in Austin, Texas around 2000. And of course, I think most of your listeners understand what has happened in Austin. And then about 10 years ago, decided to get out of the Bay Area, was ready for something different, and moved to Greenville, South Carolina. And about 5 years ago, transitioned my portfolio from single family rentals into multifamily properties. And now I'm basically what you'd call a multifamily syndicator, where I pool investors' capital and buy apartment buildings.
I love that. That's an awesome journey. I think you are so lucky that you had a mentor like your dad to really show you the way, because again, I think that education within investing, within real estate is just something that most of America, and I would say most of the citizens across the world, are not educated in that particular form. So kudos to your dad. I think he would be definitely proud of you today for sure.
Well, thank you. And I think, most people understand the value of real estate. And at a certain level, they understand owning real estate is going to be a benefit to them, but maybe they don't have the knowledge or the experience or the expertise, or perhaps even the time to get into it. And so what you're doing will help people kind of hopefully open their eyes a little bit that there are avenues outside Wall Street, outside your 401k, that you can invest in real estate and make that a part of your total portfolio and kind of build wealth and income streams in part through real estate investing.
Yeah, definitely. Okay, so I want to dive a little bit into what you just said about your transition. So you were in single family. Now, your single families were in the Bay Area and Austin, Texas, correct?
Correct.
And were you the sole owner of those properties, or did you have partners for those?
Those I was the sole owner.
Okay, so then when you made the transition from single family into multifamily, did you use 1031s or did you use a different kind of exit strategy?
Great question. So, yes, many of the single family homes I owned, I 1031 into some multifamily properties. 1031 exchanges, they kind of sound very complicated. They're really not. You find an intermediary, they'll hold your hand and walk you through it. And basically, what they do is they prevent Uncle Sam from taking a tax bite out of your profit, allowing you to have more capital to kind of keep investing. So it should be in any investor's toolkit. So I would trade single family, and I started small. I'm also a big believer in systematic step-by-step growth, building a foundation, gaining experience, and scaling that way. Some gurus will say, go big right away. I'm not one of them. I'm kind of more slow and steady. So I might have had a single family house and I 1031 it into a fourplex and slowly built my portfolio. And then at a certain point, as an investor, you'll find you start running out of capital. You can only buy so many properties, and yes, they can go up in value and you can refi and raise capital. But at a certain point, even the wealthiest people run out of capital to invest in more. And then that's when kind of the group investment started. So my first group investment was a 12 unit building that I bought with three friends here in Greenville, South Carolina. We had done a few flips together, and we'd get together and have a beer and talk real estate. And I started educating them about multifamily. So the 12 unit was my first joint venture. And from there, I built up.
I love that. Okay, so you have a 12 unit. Do you still have that 12 unit?
Yes.
Okay. So you have your 12 unit. What other syndications, and maybe explain the syndication process so that our listeners can really understand what that means and what that looks like?
Yes. So what syndication is basically a group investment where a group of investors will get together, pool their capital to buy a larger commercial asset, apartment building, could be an office building. I do apartments, I'm a residential guy. So a syndication is pooling investors' capital together to buy a large asset. And there's typically two players in the syndication. There's the LP, limited partner investors. They're the people who provide the capital to acquire these assets. And then there's the general partner, the GP, and that's basically what my team and I do. We act as general partners, and the general partners are the ones who find the asset, arrange the financing, sign on the note, operate the property, and ultimately dispose of it. So limited partner investors invest capital. They get quarterly or monthly distributions from the cash flow of the property. The general partners are responsible for the overall operation. And in return for handling all the details, the general partnership gets a share of the profit when the property is ultimately sold. And the nice thing about it is the compensation for the general partner is all performance based, and 90% of it is at the end of the deal. So if the deal does very well, the limited partner investors do great, and they don't have any of the hassles of owning real estate, dealing with, as we say, tenants, toilets, and termites. And the general partners receive a share of the profit. So for many people, busy professionals, high stress, high demand jobs, they don't really have the time to hands-on manage property. And so the syndication model allows them to invest, get the benefits of real estate without some of the headaches.
Love that. Yeah, no, that was a great explanation. I think that that really solidifies and allows people to understand what that is. So you as the GP, tell me about your team and tell me about how you go out and you identify some of these properties.
Yeah, so I'm a big believer in real estate being local. And I'm a big believer that an investor's competitive advantage is really a function of that local market knowledge. To the degree you know your market like the back of your hand, you know it street by street, block by block. That's how you can identify good value versus potential problems. So local market knowledge. I'm in Greenville, South Carolina. It's the county's about 500,000 people. The region's called the upstate. It's 1 million. So not huge, but not a podunk town either. I have two primary partners, Brian Walsh, who lives here in Greenville. He is the one who handles the day-to-day operation of the apartment. It's a business. You're collecting rent, you're making repairs, you're paying bills, you're screening tenants. He kind of handles the day-to-day operation. And then my second partner, the third man on the team, is Dan Raleigh. He lives in Cary, North Carolina. He had a long career as a CFO. So he's the analyst. He does the underwriting, the modeling, takes care of the financial and accounting. And my role is to network with brokers, investors, find deals, talk to investors, raise capital. And so it's a 3-person team, and it allows each of us to really maximize our unique skill set and allows us to do what we really enjoy doing. And you have teammates and partners who are better at other aspects of real estate investing. And so it's a good way to kind of divide and conquer and put together a really solid, well-versed, well-rounded team in all aspects of investing.
I love that. That's awesome. So I know that you said you started out by fixing and flipping some properties with your first group of investor partners. How are you generally meeting your other investors, or what kind of networking strategies are you using to raise this capital?
Yeah, so I'm very active on social media. Both Facebook and LinkedIn are my two main things. So there are people who do Instagram and TikTok. I'm older, so I'm more Facebook and LinkedIn. So I do a lot of social media marketing. I do a lot of podcasts. It kind of gets my name out there, educate people about the potential of investing. And then within my market, I'm very active in local real estate meetups, talking to brokers, talking to property managers, talking to contractors, and essentially within the Greenville investor community, people know that Arn Cenedella and Spark buy multifamily properties. We've also started to buy new build to rent properties, that we buy these kind of multi-residential properties in Greenville. So that provides deal flow to me. So that's how I find deals. And then I'd say about half of our investors are local. So again, I'm meeting investors at local meetups, networking events, and so forth. So there's no one path. You kind of spread the word, let people know what you're doing across a variety of sources through your social and professional sphere. And it's not that you're trying to sell them anything, it's more just let people know what you're doing.
Mm-hmm.
And the ones who are interested will kind of self-identify and they'll go, "Hey, Arn, well, tell me more." Or, "Hey, the next time you get a deal, let me know. I'd like to do it, but I just haven't had the time to do it." So you kind of just share your life experience, what you're doing, and you'll find people will be attracted to you and want to learn more.
Yeah, no, that's a great point. And, for my students, I like to tell them that networking is like location where you always have to be networking. And it's just as important as finding a location.
Yes, because ultimately, if you're a buyer, you have to find a seller,
Mhm.
and a seller could be selling for a variety of reasons. They've owned the property 30 years, they want to move to Florida and they're ready to sell, or maybe they've got a bigger property they want to buy, or the guy who cuts my hair, his uncle may have something he wants to sell. And so you just kind of throw it out in the universe and it'll come back to you. So it's like in the brokerage business, we'd always say you can't be a secret agent,
Mhm.
right? You can't be a secret agent. You got to let people know you're a real estate person, and you'll do that. So it's the same as an investor. And once you start making a little bit of headway, get your first one or two deals, then it tends to mushroom because once you buy one or two, you now have some street credibility that, hey, Mallory actually owns property in this area or John does. You get a little credibility, and that again helps increase the deal flow.
Yeah, for sure. So are most of your opportunities on market deals, or do you tend to find a lot of off market deals as well?
It varies. So some I have bought on market. Some of the smaller stuff has been in multiple listing. Typically, the residential MLS, you might find up to about 10, 12 units on it. Once it gets above that, it's different. And the one thing the listeners should know, uh, for larger scale commercial properties, multifamily, there's really not a multiple listing service. So you really need to network with specific brokers who sell that type of product. Um, that being said, I also do get deals off market. And sometimes they're even brought to me by brokers, but they kind of give me first look at it
Mhm.
because they know this is the type property I'd be interested in. And so even though there's a broker involved, the broker will bring it to me because one, I may be interested, and two, I've a proven track record of closing on deals. And of course, brokers want to make sales, they want to get paid. They want to earn commissions, rightfully so. I was a broker for 35 years. So, as a buyer, if you follow through and you actually close those deals, that broker's going to be more likely to bring you the next deal. Um, and I've also gotten deals through social media. So, again, it's kind of fire on all cylinders, put the feelers out there, and that's how I do it.
That's awesome. I love it.
Yeah.
Okay, so I want to know about your portfolio. Tell me a little bit more about like the expansion plans, what's coming up and are you do you have a minimum unit size that you're looking at or what are kind of the general parameters that you are investing in?
Yeah, to give you the big number, at the present time, I'm a general partner in about 1,000 units worth 125 million. So that's the big picture. Generally, with the general partner team, there's usually kind of a lead sponsor, and then they bring in co-GPs to help with certain aspects, but there's usually one clear primary leader.
Mhm.
Uh, for me, Spark and my team is honestly the lead sponsor on about 400 units worth about 50 million, and they're all in the Greenville area. So, uh, the deals where we're lead sponsor, it's in our home market. And so within that market, we'll buy anything. So in 2022, we bought a 281 unit property, 35 million. We also bought a 7 unit property, 1.1 million. So we're a little different in that we have a narrow geographic focus, but within that, we'll buy anything that makes sense. And we own properties that were built in the 70s, 80s, 90s, 2000, and new. So again, we're kind of agnostic as to the type multifamily and the size. It's more just this geographic consent. So I'm 70, been at this 45 years, ever since I was a young whippersnapper at 23, 24. And real estate's a great business to be in. You can do it forever. It's fun and you can create financial freedom. My two partners are a little younger than me. They're late 40s, early 50s. And they've both been successful in their own right. We don't have any big desire to build some huge syndication company, but we like to do 3-4 deals a year. Our typical deal size is maybe $5, $6, $7 million, where we're raising 2 million, maybe to 3 million to buy them. We have 182 investors, and currently we have about 12 million of capital invested with us as lead sponsor. So we closed the deal about 2 weeks ago, and I'm spending time looking for the next one.
Awesome. No, that's
Yeah.
great. So what's your general hold time for these properties?
So I'm a long-term investor. I'm kind of old school. I'm a big fixed rate debt guy, long-term fixed rate debt. Don't over leverage, have ample cash reserves. You know all this. This is what you teach your students, because if you set it up that way and you hold for the long term, you're almost certain to win. There's going to be a little turbulence in the last year or two for commercial real estate. It's been down because interest rates have gone up. We don't care. The properties are cash flowing, our investors are getting distributions, and we're just going to hold them. But typically, syndication deals usually run 5 to 7 years. So that's kind of the time frame. People don't want to lock their capital up forever. So typically 5 to 7 is kind of a thing. And that's a reasonable market time. For a while there, in response to COVID, printing a lot of money, really historically low interest rates, people were able to kind of flip apartment buildings every year or two. That's not a normal market. That's a one in a lifetime fluke. So it's now gone back to more typical long-term hold and invest, and that's what we do.
No, I think that that's smart. And especially if you're going to lock in a fixed rate, I think that, with your financing, they'll be a lot more favorable at that 5-7 year mark. So I definitely understand that strategy.
Yeah. It's really the long-term fixed rate financing. And for beginning investors, first-time home buyers, I would say go out and find a triplex or a fourplex and move into one of the units, get an owner-occupied loan with 3 to 5% down. Have your tenants pay your mortgage, get a 30-year fixed rate loan. And in 2-3 years, when you're ready to buy a house, great, go buy a house, but keep that rental, keep that 30-year loan. So the fixed rate financing is really the key to the kingdom. It's one of the few investments you can really get long-term fixed rate debt on, where a lot of the commercial business loans are more tied to prime and they kind of fluctuate.
Yep, exactly. And that strategy is exactly what I tell all of my students. I say your first job, wherever you're going to be working, find a location that you can buy, a duplex, a triplex, a quad, Or, if you can't find that in that market, at least find a townhouse or something where you can have roommates to, help offset some of those costs. And I think, if I could rewind the clocks of time, that would definitely have been something I would have done since I spent 8 years as a student here. So
Yeah, yeah, I mean, hindsight's always
always
2020.
2020. Yep.
And but I think, and I remember I bought my first house. It was a townhouse. It was in a rough part of town. It was right up against Highway 101, Bayshore Freeway in the San Francisco Peninsula. Uh, and I paid 107.5. I had to pay 11.75% for my mortgage. I still remember my mortgage payment, $868.08. And this, of course, is 1986. It seemed like a lot of money. I was afraid. You're a little bit nervous, as most buyers are. But really, if you have good counsel, good broker, good loan agent, you can work through the numbers. And there's something special about buying your first house. And then what I did, like a lot of investors did, when I was ready to buy a single family house, I kept my townhouse as a rental. So that was how I became an investor. That was my first investment. And from there, it just builds. So the first one or two are the toughest. And then once you kind of get into it, it's a little bit easier and you can start to scale a little bit.
Yeah, for sure. So I'm curious to hear about, so you've talked a lot about the good things in real estate. Do you have any stories that really stick out that you're like, this was a big lesson learned, like something I'll never do, that you'd like to share that maybe others can take as guidance?
Yeah, so what I would say is if you're going to be an investor, uh mistakes are going to be made. Nobody bats 1,000. You're going to make mistakes, and occasionally one can get caught up in FOMO, fear of missing out. You see the market's going up, you want to buy, uh, and maybe you don't quite make the right decision. Uh, and I can tell you, I bought 3 or 4 properties that I probably shouldn't have and made mistakes. Uh, the key, I think, is one, keep the mistakes from being a mortal wound,
Mhm.
right? So you can make a mistake, you can learn from it. There's educational value. So try to keep the damage to a minimal. And then I think the other thing, once you recognize perhaps you didn't make a good decision, uh, instead of trying to resurrect a failing deal, just take your loss and move on. So if you end up losing $5,000, 10,000, that's no fun. But if you try to hold on, it could be worse. So don't throw good money after bad. If you make a mistake, kind of recognize it, settle up, move on, and then that clears the space to find something better that's going to be more profitable. So at times during my investing career, when the market was hot, I probably got a little bit overly aggressive and maybe over leveraged a property or two. And so that's how people get in trouble. They over leverage, don't have ample cash reserves. So if you can go a little bit slower, have reserves, less loan, more cash into the property, it's going to be a little safer situation.
Yeah, no, definitely. I think that that's something that a lot of people, if they get a bad experience and they get a bad taste in their mouth, they just kind of stop versus kind of taking it as this was a learning opportunity. These are things that I won't do in the future. Uh, I've made mistakes. I've invested in things that I shouldn't have, tenants, I should have screened them better. And, we all kind of look at it and, now I know these are going to be new things I'm implementing. And it's funny because I've written and I've read a lot of leases. So I don't know, Arn, if I told you that I'm an attorney.
Oh, no, you didn't tell me that. Who knew? Wow.
Right. So it's so funny reading leases that have kind of evolved because the landlord has learned that a tenant has tried something once. And so now that is going into the lease. And now we have these extensive and unique leases, especially the ones that I read here in a college town. Like you can't have kegs on the site, no water beds, no slip and slides, just everything that these kids have done, the landlords have now incorporated it. And I think that that's a huge lesson for just general investors, is that you can't make this be the end all be all. You need to just take it, grow, learn from it, and make it a point to not make that mistake again.
Yes. Uh, owning rental real estate uh, is not necessarily easy. You have repairs, you have contractors, you have tenant screening, you have landlord tenant issues. And of course, as an attorney, you understand there are fair housing regulations and a whole list. And as an investor, as a landlord, you have to be sure you follow the rules and you conduct yourself to the letter of the law, which can prevent a lot of trouble. I've seen landlords who kind of just don't pay attention to the law and they get themselves in trouble. Have standard procedures, criteria you use to apply to every applicant. So it's rinse and repeat. The standards are the same. And it's like anything. If you learn as a kid to play baseball, you're going to strike out, you're going to make an error. You don't quit, you practice more and you get better. And it's no different in real estate. And again, it's don't get too far out over your skis. Go at a proper pace, scale accordingly as you gain experience, knowledge, and also wealth. You can then scale up. But just what I say typically is if people start investing consistently over a 10 or 15 year period, they're going to be very well off. And to one degree, 10 to 15 years sounds like a long time, and Americans want everything now. But the truth is, it's really just a drop in the bucket in your life. And so if you start something in over 10 years, you can fundamentally create financial security. That's 10 years of time that's well spent. And as you know, you're a mom. That time's going to fly. So get started now, educate yourself, and just stick with it. Be consistent, and you'll get the benefits.
Love it.
Yeah.
So Arn, what are you seeing for 2025? What kind of outlook do you have? Are there, certain things that you're kind of gearing up for?
Yeah, so I'm generally optimistic, and I I believe in the American economy. I believe in Americans. So by and large, I'm optimistic about the future. I think interest rates have started to come down, albeit maybe not as quickly or as significantly as investors would like, but I think the trend is down. Um, Over my career, I've seen countless cycles repeated, now probably 4 or 5 times. And typically, what I kind of see is real estate will have 5, 6, 7 years of growth, of boom, whatever, bull market. You'll then maybe have a year or two of correction. And I think the last year or two in both the single family market and the multifamily market, we've had a correction. And it's kind of just logical and natural. It's the ebb and flow of life. You can't keep going up. You have 6, 7 years good. You're going to have a little retrenchment, a little correction. And I think we're pretty much through that now. And so now what I expect, we're going to have a year or two of kind of flat, kind of a plateau. transaction volume, both for apartments and houses, will increase. And this plateau just sets the floor for the next run up. So my crystal ball would say the real estate market's going to heat up 12 to 18 months from now. We're almost there. And the other thing I would say, I'd always rather be 6 months early to the party than 6 months late,
Mhm.
because in my experience, when the market turns and everybody knows it turns, everybody jumps in and it's very competitive. So if you can kind of get ahead of that curve, you'll benefit by buying at a time where there's less competition and prices yet haven't started to go up. So optimistic 12 to 18 months, I think the markets will look much different.
Awesome. Well, I would tend to agree with you too. I think that interest rates will continue to fall, not to necessarily the levels that we saw, pre-COVID and post-COVID. But I do think that the equilibrium that we'll probably see the Fed at is probably around a 4.5%. I think that that's kind of where we'll land. I think that's their soft landing kind of goal once inflation kind of brings down to that, sub 3% level. And obviously with a new political sphere coming in, it's always interesting to see how that affects the economy and different markets. And I think that real estate will do well. I think that that's always a smart investment. And I think that if you are looking for a long-term investment, I think real estate's always going to be that, safe, reliable thing that it's not going away and we're not making any more land. So it's a finite investment.
Yeah, and what rational arguments could anybody make that would say the cost of housing 5 years from now is going to be less than it is today, either to buy or to rent? Uh, in my mind, there's no logical arguments that can be made that way. In my 40, 50-year career, if you look at the graph, the long-term trend is up. As you say, they're not making any more land. And we know materials, labor, the cost of all that, the cost of permits is always going up. There's inflationary pressure. The US population is growing. The other thing I would say is investors from all over the world want to invest in United States real estate. People can talk China, but the truth is America is still the leading economy in the world. And in terms of protection for private property, we're still very strong. And coming from the Bay Area, we had numerous Chinese investors, and they would be investing in California, one, to make money, but more than anything, just as the safety of their capital, knowing it's invested in the United States. So you have that foreign investment coming in. So I think when you really look at all the factors, you should have a positive outlook about real estate.
Definitely, definitely. Arn, I always like to ask my guests, are there any good books that you would recommend our listeners read that you have either read in the past or are currently reading now?
Yeah, so one that I like is Who Not How. I think it's the guy's name is Dan. I want to say Hamilton, but it could be wrong. But it's Who Not How, and uh, the concept is uh, instead of maybe learning skills that you don't have, find partners who already have those skills. So you have a great skill set, but you may be lacking in a few areas. I'm lacking in a few areas. I'm good at certain things, I'm not good at other things. And so, who, not how, is kind of how to find partners, how to find people who can do the things that you can't do, which then frees you to do what you do best. And I think basically when you play to your strengths, that's where you get the maximum advantage. So check it out. If I have my file, maybe I can find who wrote it real quick here. Who, not how.
Dan Sullivan.
Bingo. That's it. Yes. Yes. I knew it was Dan, but I forgot the last name. But that's a great book for looking for partners. So if people want to invest in group environments, it doesn't have to be syndications. It can be a couple friends, couple workmates. You go out and you buy a little 6-8 unit building, get started, and it's a good way to do it.
Yeah, love it.
Yeah.
Awesome, Arn. Well, thank you so much for being on the show. It was so great talking with you. And I mean, I always find value and always learn something from my guests. So I appreciate you. I appreciate your time. Any final thoughts that you want to leave our audience with?
No, not really, Mallory. It's been a pleasure, and I've been in a lot of podcasts. Uh, Probably never with an interviewer who has as many things going as you and a wide variety of things. So the closest university to me is Clemson University, and they're also in the college football playoffs. And I had they have a master's in real estate program, and I had the fortune to go down and make a presentation to some of the kids at Clemson. So I think what you're doing is great. It's not widely out there, and it's great that you're exposing people to these options.
Awesome. Thank you so
Yeah,
much. Well,
thank
that wraps
you.
it for another episode of Inspire Wealth. Again, subscribe to us down below here. We would love your feedback, and I'll see you at the next episode. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.